We are briefly going to discuss the world of a flagship EMD fund called the Emerging Markets Debt Hard Currency Fund. And with me to provide some insight is Ruijer. He's a lead portfolio manager of EMDHC, as it is called, in short. Marco, we seem to find ourselves in a global economy which is going up and down. It's fearful, it has its concerns. Yes. What does all of this mean for investors who want to invest in EMDHC?
Well, as an investor in emerging market debt, you always need to be aware that there are some risk and volatility involved. But typically after a bit of a sell-off, it's most of the time it represents a good entry moment. So we've seen also a little bit of spread widening of late, and we think it's actually now a good entry moment. But for the overall risk, we do have some risk where we are, of course, closely monitoring it, like the drop in commodity prices, which is really important for emerging market debt, and the Ebola virus, which is hitting especially African countries.
Mm-hmm. Are there any other big opportunities or big threats that you're keeping a good eye on?
Well, we still like more the high beta countries, especially frontier markets, cases like Ecuador, Zambia, Ivory Coast, Pakistan. But also on top of that, we like some investment grade names like Brazil, Indonesia and Mexico. And we still have also some corporate exposure, which we think is attractive versus the sovereign.
Mm-hmm. Any other kind of positioning that investors should be aware of that you are keen to look at?
We still have a tendency to be somewhat underweight treasury duration to safeguard the portfolio in case treasury yields will rise. But of late, of course, treasury yields have been going down quite fast.
Mm-hmm. And from an investor perspective, how does EMD hard currency fit into a fixed income portfolio?
Well, it's all about risk return. For us, it is a great diversification in a fixed income portfolio. You have a whole broad universe of countries, and you have in general more yield. It's actually nowadays about 320 basis points in spread over US treasuries, so you get a lot more yield for, in our view, relatively modest risks.
So we have emerging market debt and we have frontier market debt, but what's the difference between those two? What do investors need to know?
Now, if you look at the whole universe of emerging market debt, actually 2/3 is already investment grade. So you have there really safer credits, but also less yield. For the frontier markets, it's all non-investment grade. And then you can have more spread, with more risk, of course, but we think that that's a combination of risk-return is still providing good opportunities. So therefore, we are still overweight frontier markets versus emerging markets.
Sounds like enough to choose from. Thank you, Marco.